Gold just hit a level that investors haven't seen in months, and what happens next could reshape your portfolio strategy. On Tuesday, August 4th, gold futures closed at just over $4,349 per ounce. Gold opened August at roughly $4,155. In less than a week, it's climbed nearly $200. That's not a fluke, that's a pattern, and understanding it matters. Here's what most people miss. They see a number and move on. But zoom out and the picture clarifies. Gold has gained almost 4.5% since the beginning of this month. 4.5% in less than a week. That's precise movement responding to something real, and it's making investors nervous enough to rethink where they're putting their money. The monthly range tells you everything. Early in the month, gold dropped as low as just under $3,964. By Tuesday, it pushed to $4,354. That's nearly $400 of movement in a single month, roughly 10% volatility in just 30 days. The kind of movement that changes portfolio allocations. Why is gold moving this aggressively? Iran tensions. When geopolitical risk spikes, investors run to safety. Not stocks, not emerging market currencies, gold. This is the flight to safety trade, one of the oldest patterns in finance. During uncertainty, gold becomes a hedge, insurance, the asset that holds value while everything else potentially falls apart. Think about what gold actually represents to an investor. It's not a company with earnings reports that can disappoint you. It's not a government bond tied to a single nation's fiscal health. Gold is pure optionality, a tool that protects you when currency values falter, a shield when equity markets spiral. When geopolitical tensions rise and you're wondering what comes next, gold suddenly becomes far more interesting to own. The fact that gold is holding firmly above $4,100 isn't accidental. That's genuine demand. Real money is moving into gold right now. Institutional investors are rotating into precious metals. Hedge funds are adding positions. Smart money is hedging equity volatility by locking in gold at these levels. But here's where it gets interesting. This isn't speculative euphoria. This isn't a bubble forming. This is steady, methodical accumulation. Gold has climbed nearly 5% this month, but with purpose. It's not a spike on speculation. It's a climb driven by identifiable macroeconomic catalysts. Geopolitical risk, central bank policies keeping interest rates elevated, currency concerns as U.S. dollar dynamics continue to shift globally, real factors moving real markets. This is the kind of price action that tends to persist. When gold moves decisively on fundamental factors rather than technical ones, momentum tends to continue. Gold has pushed through old resistance levels and established a new trading range with a higher floor. That matters because it suggests the next move might not be down toward $3,900 or $4,000. The next move might be further upward. Now here's what you need to consider. Gold's role in a portfolio isn't about getting rich quick. It's about protection. It's portfolio insurance. When you own gold, you own an asset that historically moves opposite to stocks during times of stress. When equities sell off hard, gold tends to hold value or appreciate. That's not a guarantee, but it's a pattern that has repeated consistently through multiple market cycles. The geopolitical premium we're seeing in gold prices right now is real and justified. When tensions rise in the Middle East, energy prices can spike. Inflation concerns can reemerge. Supply chains can face disruption. Gold benefits from all of those scenarios. And if your portfolio is heavily concentrated in stocks and bonds denominated in a single currency, you're taking a bet that geopolitical tensions won't escalate further. If you're uncomfortable with that bet, gold offers an alternative. We're in August, historically a month where trading volumes can be lighter as investors take vacations. The moves we're seeing in gold happen against lighter selling pressure. That amplifies volatility, but it also means that genuine demand is carrying the market higher. That's the kind of environment where momentum tends to build. The story of gold holding above $4,100 ultimately reflects where institutional money flows and how risk perception is shifting. It's about the reality that when geopolitical uncertainty rises, investors remember that gold is the one asset with no counterparty risk. It doesn't matter who's in power. It doesn't matter what happens with interest rates. Gold is gold. It has always held value, and it always will. If you're watching this and thinking about your own portfolio, now is the moment to ask yourself a critical question. How much gold do you own right now? Not how much you think you should own based on some formula, but actually, in your actual portfolio, what percentage is allocated to precious metals as a hedge? Because if the answer is 0% or close to it, and if geopolitical risks are making you nervous when you check the news, then you might be missing a crucial tool that could protect your wealth during uncertain times. Gold just told you something important. It told you that real money is nervous. It told you that institutional investors are hedging. It told you that the months ahead might be more volatile than the calm markets we've seen in recent history. The question is whether you're positioned to weather that volatility or whether you're about to be surprised by it.